Happy Tuesday, everybody. Gina here with your weekly market update. So last week we had two disappointments. Not only did the Arizona Wildcats decline, but the market declined as well. This was mostly because investors experienced some concern with the pace of the Federal Reserve rate cuts. As far as the Wildcats, they basically just had no offense. Good thing my husband's a Yukon Husky. Go Huskies. But keep in mind that the market decline comes after the S&P set an all-time high to close out the previous week. And overall, the market is on pace for its fifth consecutive month of gains for the year. And most benchmarks have reached new all-time record highs. So we are in good shape. I do want to spend a little bit of time today discussing the market relative to a presidential election. We're starting to notice this topic pop up a little bit more frequently. And believe it or not, we are only about 7 months away from this next presidential election. So, big picture, you should take comfort in knowing that election years really don't matter in the grand scheme of investment performance. Obviously, it's fairly common for our clients to be concerned about what's going to happen to the market during an election. So I wanted to take a moment to look at the data and the facts instead of what your neighbor, or for that matter, the media, think will happen. So believe it or not, in past election years, the market has seen more positive performance than negative by a fairly substantial margin. There is actually no hard data to support a frenzy going into an election year. So here's the facts. Since the S&P 500 began, there have been 23 election years. In those years, 19 of the 23 provided positive annual returns. That's 83%. When a Democrat was in office and a new Democrat was elected, the total return for that year averaged 11%. When a Democrat was in office and a Republican was elected, the total return for that year was 12.9%. So, based off historical data, which I have to mention, of course, is not a predictor of future events, but certainly helpful, the markets seemingly, but are not bound to see massive swings. And so what the market likes is certainty. But what's most important is that we are prepared for a potential downturn, not worried about one, which is why you have us. So I hope that helps. I find that having the hard data and the facts usually does. As always, let us know if you have any further questions or concerns on your individual situation. Otherwise, we will talk to you next week.